On today's episode, we'll be talking about cash flow management, and more specifically, how much cash should you leave in your agency business? What are things to consider, and what factors determine how much cash the agency should keep on hand?
Yeah, Wook, so this is a topic that's near and dear to our hearts. With agencies, cash flow management is often a very stressful thing. So folks have to kind of navigate sometimes with clients paying too late, with payroll coming due, other expenses. Maybe we could start with just an overview of our kind of philosophy and approach to cash flow management in an agency. Maybe we can start with kind of sharing how we think about, what are the best practices that we adhere to for cash flow management?
To start it might be helpful just to understand, when you look at your P&L statement, it's typically done on an accrual base, and some companies do this differently on a cash basis, but we do our books on an accrual basis, which represents a picture of the business. So if done right, it should represent the revenue that was recognized or technically worked on in that month, and all the expenses that tie to that revenue in that month. So that should give you a clear picture on true profitability of the business. What it doesn't show you is the relationship to cash, because it doesn't say whether those clients paid or not, whether you actually invoiced for that work, and the same thing for all the expenses that went out. Did that really time with that period of, that month or quarter or whatever you're looking at? So I think cash is a completely different picture that we've looked at in a variety of different ways. I feel like we've made every mistake in the book on this area too over time. But cash is ultimately the lifeline of, can you run your business day to day? Do you have enough on hand to, number one, pay your team members, vendors, expenses, and then continue to keep the lights on for, the next day forward?
Yeah. So with that in mind, and so just to be crystal clear on that, I think there are instances where, on paper, you might have had a amazing month or quarter on an accrual basis. So, you had really amazing revenues and you kept your costs low. So, on the P&L, it looks like, wow, we had some amazing paper profits. But what you're saying is it could be a totally different picture in the bank account, because maybe, and what are the reasons why that might not match up?
Yeah. So typically some of the factors, a lot of it comes down to invoicing frequency, both from a client standpoint, but also for all of your, freelancers or variable expenses. So let's say you have, you're a project-based business and you design your contracts to be 50% upfront, 50% at the end. And let's say the difference between the start and the end could be 6 months. So you'll have a long period of time where you're paying out your team members to do the work against that project, but you're not going to receive the money for the last 50% until much, much later. So you can easily see how it can be flipped, where on an accrual basis, you might recognize it as, 25% a month or across the duration of the project. But from a cash standpoint, you may not have that money in your bank, even though you have to pay your team on a kind of more fixed regular basis.
Yeah. And so in that situation with 50% due later, if the client also is late on paying it, so let's say they're, a month, 2 months late and paying that last 50%, what could happen to the business in such a situation?
Yeah, same thing. Yeah, it definitely. Aging accounts receivables all the way across the board could lead to the same thing, where you just won't have cash in the business to meet your expenses. What is advisable here is having some kind of cash buffer in the business. So having some reserves and or access to a line credit to really support you in those lumpy months. And this is purely from a cash flow standpoint. It's not cash to pay for, projects where you might have lost money. This is purely timing of when you get money and when you have to pay out expenses.
Yeah. So just going back to the best practices. So what are some ways to design, let's say how the company, the agency gets paid for projects, also how they handle expenses? What are ways to, better manage cash?
We kind of learned this lesson the hard way. We used to do a lot of what we just described, where it's 50% upfront, 50% at the end for these longer projects. Over time, we updated our contracts. So we'll start on the revenue end, where we have a lot more frequent invoicing intervals. In some cases, every 2 weeks, even if it's a 6 month project, really splitting up the revenues so that you're receiving money in the cadence that you're doing the work. In most cases, you might be even invoicing ahead of the work, and there might be a 15 to 30 day payment term with your client. But generally speaking, you're getting cash on a very regular basis. And then with your team members, salary team members are paid consistently every 2 weeks typically. But if you have vendors or freelancers that are tied to that specific project, basically we've designed it so that we're never kind of opposite where we pay out someone before we receive the money from a client. We always try to be, I'll call it cash flow positive from that angle. So in that way, if you continue to kind of run your business that way, you actually don't need that much cash in the bank as a kind of emergency reserve.
Right. So that kind of smooths out the cash flow. And then it almost sounds like you're trying to mirror what's happening on the accrual side as much as possible so that it's
Yep.
matching the work as you get it and then the cash flow follows. How about we've seen this kind of with more of our retainer-based businesses where there is a bit of a negative cash conversion cycle where we're actually able to, have a little bit of float and get paid upfront for the work before we pay out the expenses. Can you speak a little bit more to that dynamic of these retainer, especially these that like get paid, we invoice at the top of the month and then, what happens then?
Yeah. So for the retainers, you're usually invoicing the top of the month for the following month. And in some cases, clients could pay, in some businesses, they pay with the credit card or ACH immediately. So you get the cash immediately, but the team that works on it, you'll pay it afterwards. And in some cases, net 30 beyond that. So you'll always have cash. You have float in the bank for the work and the expenses that happen afterwards. That's the ideal scenario where you have more cash in the bank than what you need to pay out later.
Well, actually, then let's take another situation where, you talked about 50-50. So there is a period where if you get paid, let's say on a big, $1 million project, you get paid $500,000 upfront before you incur any costs. How should an agency think about the cash flow situation there? Like what's kind of the way to think about it? Because now all of a sudden there's $500,000 sitting in the bank. Like, should they use that to pay some other expenses, or should they kind of, play with that money and invest it and try to make something off of it? Like what's kind of our take on that?
Yeah, I remember this happened to us where a client wanted to prepay the next year's expenses in like December of the prior year for their accounting or reporting purposes. So we were sitting on like a year of revenue. And if you just go, through the typical calculation of distributing money at a certain time interval, you could easily distribute way too much money versus what you need in the future. So in situations like that, what we did was we set aside reserves of that money in particular because we knew that we're going to have to incur expenses against that contract for the next 12 months. So it's almost like a separate, allocation or bank account in some instances where you hold that money and you slowly distribute it back into the main operating account.
So it's almost like, don't raid the cookie jar and just take amounts as needed as we do the work, right? All right, so we talked about some of these best practices, kind of the designing the scopes of work and the invoicing cadence to kind of match the work that we're doing, and then kind of also matching the SOWs with the subcontractors to make sure they're getting paid to match the work. Let's say agencies doing that well and they're starting to build up cash because they're doing work profitably. What is the right amount of cash a business should think about holding in their bank accounts? How do we think about cash for this kind of reserve purposes versus, there's other kind of things such as taxes that we need to think about as well. So maybe we can dive into those considerations.
I think and this answer varies based on the design of the business. Like what I mentioned, if you are a very project-based business where the cash is very lumpy, you may need to keep a lot more cash in the business. Let's call it, 3 to 6 months of cash, 3 to 6 months of expenses of cash in the business. But if you're a more kind of retainer-based business where the cash comes in a very consistent cycle, then it could be lower. I'll call it, 1 to 3 months of expenses in the business. I would say there's risk in, if you keep too much in the business, you may get too comfortable with and you may take on risks with projects and keeping a team member that might not be performing, or really you can compress your margins because you have the feeling of having a lot of cash in the bank. And what can end up happening is you start burning down on your cash reserves, and running a not ideally profitable business. So I think there is a good exercise of distributing profits at a regular interval. And then whether that's the partners or putting it aside in a different bank account, and then deciding what to do with that money, whether it's reinvesting in the business intentionally, or maybe even going out and doing some M&A to acquire another business line.
Right. So,
So,
I think a good example to kind of talk about, because I think this has happened to a lot of other agencies, and I think we've been in this situation as well. You have a period where you build up a pretty significant cash reserve. So let's say beyond 3 months, maybe 6 months, sometimes even a year's worth of cash that can cover all the expenses, right? And so just on paper, you might think, okay, like we have a very strong balance sheet, we can weather storms. And so in such a situation, and I've heard this, just in conversation with other agency owners too, where you're doing well, but then all of a sudden, let's say new business dries up, you have some client churn, and you have this sense of, hey, we have the cash and I think the business will pick up again. So let's weather the storm. In those instances, typically the agency owner will draw on those cash reserves to make payroll, to continue to make sure the team is kept together. And we've done this. We've talked ourselves into like, hey, look, like we're protecting jobs. We're keeping the team together because this is a good team. And we want to make sure that when the opportunities come back, we're ready to service those things. Let's talk through that. Like you could argue, I mean, at the end of the day, it's anyone's choice to do that with their own money, with the dollars that they have saved. But like, I guess going back to what you're talking about, the comfort level, like why is this in the long run, like not advisable? And, what are kind of the alternatives and how we think about, such situations now?
you're right. Ultimately, it's the owner's decision on how they want to spend their money, right? And it's interesting because if you do have the buffer, you do have the luxury and the ability to make those decisions to say, I'm going to keep this team because I think this is a temporary dip, but I think it'll come back and we're going to need those team members in, 3-4 months. And if you can weather that storm and get through it, I think that's definitely a decision that could be made. But if you didn't have that cash reserve, you would be making very different decisions. And I think it's just really, and no one can predict the future, right? Is the dip going to be for 1 month? Is it going to be 3, 6 months? And at a certain point, the owner, the key stakeholders need to decide, how long is enough to keep burning down on our reserves. So it's not it's a emotional decision. It's not a clear decision where, how to decide when you are burning down on your cash and running a not profitable business.
Yeah. I mean, you think on one end of the spectrum, you go, hey, like maybe we should all be super ruthless. And like the moment, business is signaling a downturn, you make cuts right away. And then you kind of, brace yourself to weather the storm by making proactive cuts and make sure your expenses are low. And then not have to tap into any reserves. And then on the other end of the spectrum, it's kind of like, hey, protect jobs at all costs and, use your own dollars to kind of get through the tough period. But yeah, both have pros and cons. I think, if you're way too ruthless about certain things, then yeah, you can sacrifice on really good talent that are going to, that's going to be handy in the long run. But then at the same time, if you're a little too slow or like you don't confront the situation in a clear-eyed manner and then make tough decisions, it could kind of lead to a vicious cycle where like, you've kind of like you've gotten to the habit of drawing on reserves to get through tough periods. And like, I think that impairs your ability to run like a good business in the long run. So maybe there is like a happy balance where like, you kind of make decisions a bit more rationally with some of these considerations of like, hey, I do need to preserve certain talent, but I do need to also make some tough decisions.
Yeah, definitely. I think one thing that definitely helps in situations like that is having a clear view of your cash flow forecasts. And we've gone through a variety of different evolutions of this through the years. At one point in our initial business, Barrel, we had almost a full year, 1 year rolling forecast with a lot more, obviously granularity on the 3 months forward. And literally every invoice with when we thought it would come in to if it got delayed, when our new projection is for when we'll receive that money to every single line item of expenses that are leaving your bank account. And, that level of granularity, I would say, is not needed now, but in certain like situations where you're really tight on cash, your profitability is down, it is a good exercise to run through to
Yeah.
see if your bank account is here now in 3 months, where will it be? Day by day is a very helpful picture to have. And then we had in some cases, weekly or daily look at how is our forecast doing and maintaining a healthy picture there. I would say, when times are better and, your finances more accurately reflect the accrual picture, it's not needed, but I think it's a good exercise to run through.
I distinctly remember that period. We had hundreds of days of runway, which felt great. And it's like, oh, awesome. Like, our business is solid. And then we had single digit days where, we're like, holy cow, if some of these payments don't come through, like we are really screwed. Like, just insolvency is right around the corner. The imagery that was always on my mind was kind of the old time cartoons where, there's that kind of, what do you call it? The circular saw that's like kind of cutting the wood, and then like a cartoon character is tied to that piece of lumber, and then you're getting like just closer to that buzz saw, but then like all of a sudden the lumber gets extended and you kind of get a few more days. But like we were always like, oh, let's just like avoid that saw, prevent ourselves from getting cut. So that was always the feeling we had kind of on the back of minds. I mean, nowadays it's a lot saner, and like maybe we could get into that, like as we've expanded from just managing cash flow for one agency to now we do kind of think about cash flow management centrally across our Barrel Holdings agencies, so multiple agencies, and we're supporting them with a centralized finance operation where cash flow management is very much handled centrally. How do we think about that, and what's kind of changed from a single agency model to a multi-agency model?
A lot of the fundamentals are the same. So how we design the contracts, how we pay team members, a lot of those practices we've shared with all the companies in the portfolio. We go through a quarterly cadence of distributing profits, both to existing team, to the holding company. And then on a quarterly basis, we're also allocating funds for taxes to go to the holding company as well. And then a remaining amount we leave in the business to continue growing each business's cash reserves. And then at the holding company level, we take the money and we kind of go through the same exercise where we do have expenses at the holding company level. We'll set aside amount for the reserves that we then use for investment into either agencies or M&A, and then kind of go through that same cycle with distributions and et cetera. So the advantage of this is we have reserves at each company and there's reserves at the holding company level. So in a catastrophic situation where one of the businesses runs out of all their cash reserves, the holding company can kind of backstop them if needed.
On that point of catastrophic situations, and we've obviously had our share of such situations, but maybe speak to kind of what are some of those types of situations, when do they happen, and in those situations, like beyond just what you have in the cash reserve. So let's say as a business you think the appropriate amount is 2 months, 3 months, 4 months, whatever you might have. But beyond that, what are some other protections or things that an agency can have in place so that come, some of these unexpected situations, they can make sure that the cash reserves plus whatever else can help get them through such periods?
I would say from a day-to-day operation standpoint, that amount of cash reserves should be plenty. Let's say all of your clients don't pay. Yeah, in a worst case scenario, like you'll still have enough cash to make it through, 2 to 3 months. But there could be situations like, legal matters where a client ends up suing you or employee ends up suing you. There could be some kind of situation where it could go way beyond the amount that is at stake is way beyond what you have in the bank. And that's where insurance comes into play, having really good E&O insurance policies, liability insurance policies, and when you don't need them, they seem like just an expense on your P&L. But when you do need it, it can really save your business because, a lawsuit that is millions of dollars could easily tank not only your current cash position, but future cash potential and really just take your business under. So I think it's an important part of just making sure you have insurance for kind of the right areas and enough coverage to, based on the size of your projects and the size of your business.
Yeah. And maybe how
Uh,
about on the financing side, like line of credits, credit cards, maybe you could speak a little to kind of like when is it appropriate to leverage those instruments versus, the cash reserve?
Line of credit, I would say, number one, it's good to have. So as soon as you have the credit history that allows you to open up a line of credit, you should do that and continue to revisit the amount as your business grows. That's really a tool as as an emergency. All right. In terms of order of operations, it's almost use your cash because it's probably not. It will be a lot cheaper to use your own cash than use your line of credit. Because typically, line of credit is interest rate north of 10%. Potentially even further. Versus if your cash is sitting in a savings account at, let's call it 5%, much cheaper to use your own cash for temporary dips like that.
Yeah. Anything on the credit card side, or there are some that could be used as a line of credit on its own, right?
Yeah. Some credit card companies both give you lines of credits as an option. Some have 0% interest for X number of days. In some cases, it is appropriate to use that. That could be the cheapest form of just delaying a credit card payment for 30 days because they're not going to charge you interest and it's a temporary dip. In general, I don't love the practice of delaying things like that, but it could be cheaper than using your own cash for sure.
Yeah. Gotcha. So I mean, it's not too different than personal finances where, you don't want to carry a lot of, credit card debt and, just have to, if you can pay with your own cash, you do. But then, there are some things that you do want to finance over a longer period of time if you can.
Yeah, definitely.
Great.
Yeah.
So, as we kind of wrap up this episode, maybe just going back to that question, because I don't think, I don't think it's a satisfactory answer for listeners, but it's something that, maybe we can kind of recap for them. So, how much cash should an agency hold in their business? What's kind of your final kind of, recommendation here?
I hate to say it depends, but I'll say low end 1 month, high end probably 6 months of cash in your business. And if it goes beyond 6 months, it's only because you have some really big contracts that you're holding, that you're getting prepaid for, that you need to keep the cash on hand.
Yeah. And maybe one last kind of point that we should make is a lot of times, like cash in your cash reserves, these are amounts that you've paid taxes on for the most part. And these are basically profits that you've decided to keep in the business. And so in many ways, like beyond the cash reserves in your business, there is also cash that as the owner of the business, you can write back into the business. Maybe as a parting thought, you can kind of reflect on that.
Yeah, I think you mentioned a good point. These are post-tax amounts. So every business does it slightly differently, but your cash reserves aren't the amounts that you're saving for taxes. That's something completely separate. That's expected to go out as a liability to the government. These are profits that you're setting aside, for reserves. Beyond that, I would say the owner takes distributions. And if you do want to make investments into different areas, the owners could write checks into the business and be deliberate about, measuring the return on those investments. So in some ways, we feel like it's cleaner if you do want to invest in, hey, I want to create a software product, let's say within my agency, or I want to go acquire another business, cleanly separate that out. And it's almost like don't muddy the cash reserves by spending that money for those purposes.
Yeah. Or just kind of the situation we talked about. If I want to, save jobs, if I want to help my agency survive, that's also a situation where the owner can write a check back into the business and, you treat it as a loan, treat it as an investment, whatever it might be. I think those are valid reasons to kind of think about cash reserves. Okay. Well, thanks for tuning in. We'll see you all next time.